we'll just talk about two key charts that are extremely important from an investing point of view. Now, you often get to hear from advisors, financial advisors, and even fund managers talking about how 3 to 5 years. 5 years is a time frame that everybody talks about, saying at least stay invested for a 5-year period or more, at least stay invested for a more than 5-year period. This is a number that you keep hearing. Now, let's break these numbers and try and understand where is this 5-year number coming from. Now, if I take rolling returns, so in this chart here, you can see 1-year returns, 1-year rolling returns. We have taken data from December of 1999. Every 1 year, we keep calculating rolling returns all the way until now. Like that, we take a 2-year bucket, 3-year bucket, 5, 6, 7, 10, 14, 15, rolling returns all across. And we try and see what is the probability of negative returns in these time frames. You can see that on a 1-year time frame, there is a 23%. So 23% probability, or rather 23% of the time, your 1-year return, 1-year rolling return has always been negative. If you increase that to a 2-year time frame, it comes down. Your probability of your return being negative is 16%. It drops to 5% on a 3-year basis, 4%, 1.5% on a 4-year basis, and 0.1% when it comes down to a 5-year. And 5-year on, just around 5.5 years or so, from there on, you can see that your probability of making negative returns just becomes 0% if you look at history. Again, we're looking at historical data and trying to make inferences as to how this is likely to be in the future. So the 5-year number comes from this. The fact that if you hold on to your lump sum investment, this is the large cap space as an example. So we have taken the Nifty TRI index, the total return index, now which includes dividends as well. Now, if you stay invested for a minimum time period of just above 5 years, you have never really seen your capital being lost. That is the most important takeaway from an investor's point of view. Now, the second point is that we don't really invest in the markets just to save our capital. We want capital appreciation, but we want to make profits. Then it comes on to this table here. So what do we do here? We are looking at all the time frames across all the same time frames, 1 year to 15 year. What is your probability that your return is negative? The same thing that you saw in the previous chart. You can see that here. Above a 6-year time frame, you have a 0% probability of your return being below 0, of negative returns. Now, we are important as to what is going to be, I think the 7-year to 12-year, I think these three are the most important time frames to actually look at. Now, 7% loosely, you can say, is your FD return. What is the probability of hitting FD return? What should be your time frame? 100% of your time, if you're there above 12 years, you've always made 7% in the market. But when you come to equity markets, it's all about probability. 100% is not always there. As long as you're getting a number above 70 or above 80, I think it is a realistic probability. So if you're looking at it you have a 92% probability that any 6-year bucket that you take from December 1999 would have made more than 7%. 92% of the time you've made more than 7% if you have invested in the market for a minimum 6-year period. Now, if you want more than 10% return, or rather, let's take 12% return, because if you look at Nifty and if you look at large cap, in and around just above 12% has actually always been your historical CAGR for the market. So if you look at that, then I think these two time frames become important. 67% of the time you have made more than 12% return if you're invested for a 6-year period. 70% of the time you have made more than 12% if you're invested in the market for a 12-year period, and that goes up to 79. So two key takeaways from an investor point of view. One, it stresses the importance of staying invested for a minimum 5-year plus period. That increases your possibility, rather it increases your possibility of making positive returns, of not losing your capital. Second, from a profit point of view, return point of view, 6 years, 12 years, 15 years, these seem to be very important time frames that you actually have to look at from an investor point of view, where you are increasing your probability of making that 12% CAGR. I think these are the two most important takeaways from an investment point of view. Now, last chart here it talks about phases in the market, phase 1 to phase 7. where you can always see here that your phase 1, phase 3, phase 5, phase 7 are much larger in time frame and in size, in quantum, in magnitude, compared to your phase 2, phase 4, and phase 6. So your market is filled with upsides and downsides. The point here is to stay invested in the market for a much longer period of time to take advantage of all these phases that are longer and higher in magnitude. Also take advantage of the phases 2, 4, and 6, where you try to average your cost of investment. And lastly, I think we'll leave you with this quote here. Nature is not in a hurry, yet everything is accomplished. Now, time frame, time horizon is everything in the markets. If you plant a seed, you come back every single day to see if that seed has actually grown into a tree. You would be disappointed every single day. It takes time. So you will have to take care of your investment like you're planting a seed. Time frame is the most important in equity markets. You're in here, you're in the markets for wealth creation, not from a trading point of view, which is why we keep stressing on how it is extremely important to stay invested for a longer period of time and not look at 1 year, 2 year, 3 year time frames. You can look at 1 year, 2 year, 3 year time frames, but if you do look at shorter time frames, you must also be cognizant of the risk that comes with it, and accordingly you will have to get into asset allocation. We'll talk about that in next month's E.M.I. Till then, it's Arjun Nagarajan signing off. Have a great month ahead.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.